Pre-London session, GBP USD was trending up, bouncing perfectly off the upper VWAP standard deviation band, a dynamic area we know acts as a key zone for value in the trend pulse metric. But then, price slips below the upper band and heads toward VWAP, where it consolidates. This was the first signal of a weakening trend pulse. But here's where most traders go wrong. When London opens, we get a strong bullish candle. Buyers pile in, looking for the trend continuation. But what they didn't see was smart money already positioning themselves for the big move. This bullish move was pure manipulation. Smart money wasn't joining the ride, because those early buyers' exit positions would later be used as liquidity by smart money who have the intentions of getting in cheap at lower prices. After the bullish trap, price consolidates at the upper VWAP standard deviation band. What was once support is now resistance. Then, price pushes below VWAP and attempts to recover, but fails. Here's where the cluster search indicator brings the story into focus. On the candle that started the flush, we see massive stacked sell imbalances, the day's highest volume, and a shocking sell delta of 14.31. Compare that to the average delta of around 100 or minus 100, and it's clear this isn't a regular move in the market. And to add to that, there were no news to justify this. It's pure smart money manipulation. The next candle is where everything clicks. It's a larger bearish candle with even higher volume. But, and this is critical, it closes near the middle instead of its lows. This is textbook VSA climactic action. Think about it. If smart money were genuinely selling, wouldn't the candle close at its low? Instead, they're absorbing up all the selling pressure, positioning themselves for massive buys. The cluster statistics indicator makes it undeniable. Look at the delta, bullish. Sellers are being absorbed, and smart money is stepping in. See, price had been consolidating for weeks, finding value around this area, and the point of control at 1.2647 served as a magnet for institutional buying, and the selling climax confirmed it. This is what caused the sideways movement, which was the accumulation phase before the reversal started. Once the accumulation phase ended, the market starts showing its hand. The first sign of strength. Price breaks above VWAP and clears the initial selling candle. Then a retracement back to VWAP, which was once resistance, is now flipped and becomes the last point of support. At the second test of VWAP, stacked buying imbalances show up, indicating that buyers are getting aggressive. This was the second sign of strength. For the third sign of strength, price tests VWAP one more time at the same area where buyers got aggressive. Then, during the ISM Services PMI news, a large bullish candle breaks through the inverse head and shoulders neckline, perfectly aligned with the upper VWAP standard deviation resistance. The breakout led to price trading higher, confirming the start of the markup phase. If you're tuned into Market Trinity, these signs are glaringly obvious. Volume confirms the aggression, value aligns with institutional levels, and volatility breaks the stagnation. Fast forward to December 6th, the uptrend stalls and smart money begins their exit. A large bullish candle appears with ultra high volume, closing near its high. Traders might see this as bullish continuation, but the delta metric reveals a negative delta. This is climactic action. Smart money isn't buying, they're selling. After this, price drifts upwards slightly on declining volume, signaling the start of the distribution phase. Then comes the upthrust, a bearish pin bar with significant buying delta concentrated in the tail. Turn on the cluster search indicator and it highlights aggressive buying orders trapped at the highs. price immediately reverses, and a bearish engulfing on the next candle confirms the shift with the biggest sell delta since the distribution phase. Sellers are now taking liquidity from buyers. For those familiar with ICT concepts, you might notice this bearish candle formed a fair value gap, but by applying the principles we've already covered, you gain a much deeper understanding of what's really happening here. Take the earlier bullish climactic candle as an example. It also created a seemingly convincing fair value gap. However, if you tried to buy on the retest, it would have failed, as price sliced straight through it. Why? Because fair value gaps are only as good as the intent behind them. And here, the intent was distribution, not continuation. The final nail in the coffin comes with a no demand bar, a bullish candle with bearish delta. Sellers were absorbing buyers' volume to prepare for the next leg down. And when the confirmation candle hits, the sell-off began, marking the largest bearish leg since the markup phase. This trade is a crash course on why the Market Trinity and the 7 key metrics are so powerful. By understanding volume, value, and volatility, we could understand major moves. The false trend continuation, pure manipulation, spotted by trend pulse, and VWAP dynamics. The accumulation phase, clear as day through climactic action, delta, and imbalance metrics. The distribution phase, the liquidity drivers, and exhaustion metric exposed the exit strategy. And what about the traditional ICT concepts like fair value gaps? They're great, but without the deeper understanding the Market Trinity provides, you're still trading blind. This trade wasn't just about entries and exits. It was about knowing why smart money did what they did and aligning ourselves with them. This is what separates the 10% who win from the 90% who lose. Now, let's take a look at another example to keep sharpening that edge.